Hey, this is Danielle. Welcome to the free video. So, today I'm going to talk about a way to potentially hedge the spiders. Why would we want to hedge? Well, because the market has shifted patterns here. We're now below these areas of key resistance. We have not been able to get up above it around this 440 price point. Definitely a key line in the sand around 445 or so. And with today's nasty wick after the 1-2 sessions ago, it's just not looking good for more upside. In order for us to get more upside in this market, we need to have buyers come in. We need to have a break of this area of resistance and a follow through day, which has not happened yet. So that means the path of least resistance is down. So how would I trade it? Well, typically when I'm looking to hedge, I usually want to do something cheap because if it doesn't work out, it's not that big of a deal. And I'm not really the type of person to hedge while the market continues going higher, but when I see a good downside setup, then I'll come in and do it. So what would I do? Well, first of all, I want to look at a target. So my target is going to be a retest of these previous lows. And then after that, it would be, okay, so what happens if we retest these lows and break? Because I think it's pretty probable we meet this target. This one, not as probable, but it could happen, right? So how could I trade either move? Well, first of all, the level that I'd be looking for a retest of this lows would really be between 425 and 430. So let's go ahead and look at what that would look like if I went ahead and put on a trade. So let's see. We have here, we would look for about $10 to the downside. Let's say it comes through. Yeah, that would make sense within the next, let's do it by the 18th would be Monday. If I give it a little bit more time to the 22nd, I think that would make sense because you have a $12 expected move in that time frame. So let's try looking at a 425 price target. So basically I would come in here and I would say, okay, I want a low risk, high reward strategy that would pay me if I'm right. So 435, let's start with a 435 put, 425 put, 415 put. Now, this trade is $10 wide on each side, but it's only costing me $1.42. That gives me a fantastic risk to reward. My max loss is $1,400 and my max profit is $8,500. Now, obviously, that's if I was dead on and if the spiders went to 425 the same day of expiration. But it doesn't even need to do that for you to make good money on it. You can still, let's say that the spiders went from 435 to 430 around the same time. I mean, you could still double that, if not triple it. So butterflies get a bad rap sometimes because people think like, oh, you need to have it go to this exact target for you to make money. But you don't, because when you have 435, 425, and then 415, and if the price falls and it stays within this zone, you can still make money. You just won't make as much money as you would if it went to that exact target. So this is a good way to have a super low cost spread on butterfly spread where, hey, if the market goes down and retests the lows in the next 11 days, how could you make money? This is how you could do it. Now, that being said, if I'm completely wrong and the stock market does not go below 435, then this would go to 0. So I hope that you found that helpful. And other than that, I hope you have a great rest of your day, and I'll see you in the next one.
Hey traders, it's Danielle here with Simpler Trading. Thanks for watching. If you enjoyed this video, be sure to like and comment down below. Also, be sure to subscribe and click the bell icon so you will never miss the latest take from our trading experts. Did you know that we provide real-time trade alerts so that you know exactly what we're doing, exactly when we're doing it? Go to www.simplertrading.com to learn more. Good trading, and we'll see you in the next video.